Ever wondered why accounting is often dubbed as the language of business? Well, it's largely due to the set of fundamental principles it abides by. These principles, known as accounting principles, are the backbone of any business operation, guiding decision-making and financial reporting. Today, we're going to explore 8 key principles: the historical cost concept, periodicity concept, revenue recognition concept, matching principle, conservatism principle, accrual concept, consistency principle, and materiality principle. So without further ado, let's delve into these principles and understand their significance. Starting with the historical cost concept, a principle that's all about objectivity and verifiability. This concept states that a business should record its assets, liabilities, and equity investments at their original purchase cost. Think of it like this. If you bought a piece of land 10 years ago for $50,000, even if its market value is now $100,000 in your books, it's still worth its historical cost of $50,000. Now let's shift gears to the periodicity concept. This principle is all about timing and states that businesses should divide their activities into time periods. These periods could be monthly, quarterly, or annually. For example, if a company earns $1 million in a year, it would report its earnings quarterly to provide a more regular and detailed financial picture. These 2 principles lay the groundwork for financial reporting, ensuring that figures are based on factual data and are reported at regular interval. Next up, we have the revenue recognition and matching principles, the backbone of income determination. The revenue recognition principle dictates that revenue should only be recognized when it is earned, regardless of when the cash is received. So if you sell 100 bicycles in April but don't receive payment until May, you still recognize the revenue in April. It's all about when the transaction occurs. Now let's pivot to the matching principle. This principle states that expenses should be matched with revenues. In other words, the costs of doing business are recorded in the same period as the revenue they help to generate. So if you bought tires in April to build the bicycles you sold, you'd recognize the expense in April, not when you pay for the tires. These principles ensure that income is recognized when earned and expenses are recorded when incurred, leading to accurate financial statements. Now let's bring in the last 4 principles, starting with the principle of conservatism. This principle advises us to anticipate no profit but provide for all possible losses. In other words, when in doubt, choose the option that will least likely overstate assets or income. For example, when valuing inventory, accountants choose the lower value between cost and market value. This way, if the market value drops, your financial statements won't be overstated. Next, we have the accrual concept. This principle states that financial events are recognized by matching revenues to expenses at the time when the transaction occurs rather than when payment is made or received. For instance, if you provide services in December but don't receive payment until January, you would record the revenue in December when you earned it. The third principle is the consistency principle. This principle requires that companies use the same accounting methods, period over period, so the financial statements of different periods can be comparable. If a company decides to change its accounting method, it must justify the change and show its effects on the financial statements. And finally, we have the materiality principle. This principle states that all materially relevant items should be reported in the financial statements. Materiality depends on both the amount and the nature of the item. For example, if a company purchases a stapler, its cost is immaterial and can be expensed immediately. However, if the company purchases a building, the cost is material and needs to be capitalized and depreciated over its useful life. These principles guide accountants in recording transactions, ensuring that financial statements provide a true and fair view of the company's financial position. So, we've journeyed through the 8 fundamental accounting principles. From the historical cost concept, ensuring objectivity and reliability, to the periodicity concept, which breaks financial life into meaningful intervals. We've explored the revenue recognition and matching principles central to income calculation. We then delved into the conservatism, accrual, consistency, and materiality principles, each playing a crucial role in creating trustworthy and comparable financial statements. Remember, understanding these principles is key to mastering the language of business accounting. Until next time, keep crunching those numbers.